Imagine unlocking the secret to maximizing your real estate investments, making your money work harder for you. What if the answer lies hidden in the interplay between bond yields and cap rates? To understand how bond yields impact cap rates, let's first break down these terms. Bond yields refer to the return an investor can expect when they purchase a bond, essentially a loan to the government or corporation. When interest rates are high, bond yields increase, making them an attractive, relatively safe investment. Cap rates, or capitalization rates, are used in real estate to determine the potential return on investment properties. It's calculated by dividing the net operating income by the property's current market value. A higher cap rate suggests a potentially higher return, but usually comes with more risks. Now, here's where things get interesting. Bond yields and cap rates often move in tandem because they both respond to the broader economic climate. When bond yields rise, it signals higher interest rates, which can lead to an increase in cap rates. Why? Because investors expect higher returns to compensate for the increased cost of borrowing. Conversely, if bond yields drop, cap rates often follow, as borrowing becomes cheaper and demand for stable investments like real estate increases. Let's put this into a practical scenario. Imagine you're considering investing in a commercial property. Currently, the bond yield is at 4%, and the cap rate for similar properties in the area is 6%. In this situation, the spread between the two rates is 2%, suggesting a reasonable risk-return balance for investors. However, say the Federal Reserve decides to raise interest rates, pushing bond yields up to 5%. As a result, the cap rates might also increase to maintain that spread, perhaps moving to 7%. This shift would make the property appear riskier or less attractive unless the income from the property also increases to justify the new cap rate. What does this mean for you as an investor? If you're considering purchasing real estate, it's crucial to keep an eye on bond yields as an indicator of where cap rates might be headed. A rise in bond yields could signal tougher times ahead, or it might mean waiting for property prices to adjust. On the flip side, if bond yields are falling, it could be a prime opportunity to lock in properties at lower cap rates before the market catches up. Reflecting on this dynamic, it's clear that understanding the relationship between bond yields and cap rates is vital for making informed investment decisions. So, the next time you evaluate a potential real estate investment, consider how shifts in bond yields might affect the cap rates and, ultimately, your investment's profitability. In the ever-evolving landscape of real estate, staying informed and adaptable is your best strategy. By recognizing how bond yields can sway cap rates, you're not just reacting to market changes, you're anticipating them, positioning yourself to make smarter, more strategic decisions. In this way, you can ensure your investments aren't just surviving, but thriving in any economic climate. Thanks for watching. Please subscribe to the channel for more investment insights.